All right, so at last we are all doing well, and well, we I really want to understand what is happening that our people are not really joining the meeting, but that is fine. So, uh, this month the focus has been on investment, okay, and then throughout the sections that we've had on weekly basis, we understood what investment really means, right? And then after that, also we understood that there is uh, a certain level of risk associated with every investment option or vehicle that we decide to choose and then go in, right? So we covered a lot. And then last week also we understood how time and compounding can be to our advantage, right? And today, all that we want to understand is every investment vehicle or avenues that we have available and which ones that we can also consider exploring ourselves and also deciding to put in our energy and time into. So without much ado, I'll invite Ahmed to take over for us.
All right, so thank you so much, Sebastian, for the introduction. And as you rightly said, we are almost journeying towards the end of this cohort. And tonight's session is on. We are currently in week 11, and that means next week will be the end of this cohort. And for tonight's session, we are going to focus on the investment avenues. And that's what we are going to focus for tonight. So, Sebastian, please, can you share your screen so that we can start right away? All right, thank you so much, Sebastian. So, as I said, tonight's session is focused on investment avenues, and another word for it is the investment vehicles available for everyone interested in investment. Okay, so as usual, I'll start with the core truth, which we normally talk about every single session that we've had. For tonight's session, it is different financial tools serve different financial goals. Different financial tools serve different financial goals. And this is true because if you remember, 2 weeks ago when I was talking about what really investment is, we talked about the need for you to develop or generate your own financial goals and then try to allocate the best investment tools for it. You don't just rush into any form of investment vehicle just because people are recommending it or something. No, you first have to sit down, set your financial goals, whether for education, whether emergency fund, whether retirement or anything. Then you determine which financial to serve that your specific financial goal. Okay, so there's nothing like best investment. There's nothing like best investment. There are investments appropriate for your specific goals. Okay, so every investment has a purpose that it plays. It is some investments are appropriate for your specific goals, some are for your time horizon or risk tolerance. Okay, so you as the individual, it is your responsibility to understand the best financial tool that serve your financial goals in order to avoid any costly mistake. Now, let's talk about the broad categories of investment avenues. Okay, so we have two main broad categories of investment, and that is the fixed income and then the growth assets. Okay, so this will help you to understand which investment is best for you. Okay, based on the categories below. Now, let's start with the fixed income. Okay, another name for it is the preservation and predictable returns income. Okay, because it is known to target preservation and returns, predictable returns. Okay, so the fixed income are investments that prioritize your capital preservation and steady predictable income. Okay, so the purpose of the fixed income is to preserve your capital and also to ensure a slow and predictable return. Okay, so they fluctuate less. The risk is very low. The risk level is very low, but the growth is very slow as well because there is no any risk associated with that. And as we all are aware, we know that the law of investment says that the lower the risk, then the lower the return, and then the higher the risk, the higher the return. So for the fixed income, the risk level is very low, and that is why the returns is also very low. So now let's look at some of the examples of the fixed income. The first one is the savings account, which is extremely safe, but the returns are extremely low. Okay, you have to because we all know that there's no way you will be able to lose your capital when it comes to savings account. Then another example is the fixed deposits. We have the T-bills and we have the government bonds. So all these are examples of the fixed income. Okay, so now you might be wondering, who is the best fixed income best for? So you have to understand that if your goal is a short-term goal, or you are targeting safety buffer, or you are a risk averse individual, or you just want to preserve your capital, then the fixed income is the best investment avenue for you. Now, what are some of the limitations regarding the fixed income? The first one is your returns will barely beat inflation. And as you all know, because the level of return is very low because the risk level is low, and so it's very hard. But it's better than not even investing at all. Okay. So another limitation is your money will be safe, but then the growth will be very slow or steady. So you really have to understand that. Then the second category of investment avenue is a growth asset, which is known for capital appreciation plus higher returns. If you remember, the fixed income was focused on capital preservation plus steady returns. But for this one, it is capital appreciation plus higher returns. So for this investment, it prioritizes long-term growth and it fluctuates significantly, but historically, it delivers a higher returns over time. So for this growth asset, you really have to know that there's going to be a high level of volatility. And I remember last week we talked about volatility. There's going to be a high level of volatility. That is the movement of the price from up and down. Your portfolio will be like today you see like your portfolio is growing, tomorrow is crashing and all that, but it's normal when it's come to the growth asset. Okay, so some of the examples of the growth assets include the stock, or what we normally say the shares. That is a part ownership of a business or a company. So we all know that how the stock market works. It is highly volatile, but it also has a high potential risk return. Okay, so when you invest, you know that there's going to be up and downs of the prices. But then it also has the you also stand a huge chance to make a huge amount of money. Then another example is the mutual fund. Okay, so for that one, individual individual investors will come together, pool money together, hand it over to portfolio manager to try to manage to ensure that the money is growing and all that. There's a level of risk associated with that, but the return is, as we all know, very high. Okay, we also have the index funds, we have the real estate, and lastly we have business ownership. Yes, building your own business is also part of the growth asset because the risk is very high. I don't remember the exact percentage, but I know around 70% of businesses fail in their first year or something. I don't remember the exact stat, but this alone should tell that it is also very risky. Now, if you are someone with long-term goals, or you are targeting wealth building, or you are an investor with high risk tolerance, then the growth asset is the best investment avenue for you. So the limitation here is that if you are in for short-term, quick returns, then it's not going to work for you because of the volatility. And also, it will require patience and discipline before you're able to benefit from that. Now, let's talk about the trade off. Safety costs you growth. Okay, safety, and we all know that safety has to do with the fixed income. That one, it will cost you financial growth because you are in for capital preservation. But if you go in for the growth, which is the so if you go in for the growth, which is the growth assets, then you just have to understand that there's not going to be stability for your portfolio because it is highly volatile and no way you can have both. You just have to choose based on your timeline and goals. But then one thing you also have to understand is this: there is some way you can have both, and that is diversification. I remember last week, is it Fibua? He asked about diversification and whether it matters or not. It's just unfortunate that he's not here to answer that question. So when we talk of diversification, it simply means you trying to spread your money across different investments in order to reduce risk. In another word, it just means that okay, now why does it matters? Why does diversification matters? The first one is individual companies can fail. That one is true. If you buy MTN today, tomorrow if the company collapse, you are in trouble. And also understand that individual sectors can collapse. So the tomorrow if something happens to agriculture, the agriculture industry can also collapse or anything. And that is why diversification really matters because you decide to spread out your money so that when something bad happens to a particular industry or a sector, it won't really affect all your investments. So now let's look at how diversification truly protects you. Okay, so let's say Sebastian has 50 companies, and then unfortunately for him, five failed. That means that he has lost just 10% of his total companies, right? This is painful, we all know that, but at least it won't be the end of his life for him because he still has 40 companies to manage, and that is how powerful diversification is. Now, imagine that Sebastian only had one company and unfortunately it fails. That means that he has lost 100% of his everything, and that one is more catastrophic. Okay, and that is why diversification matters because when you lose a particular stock, it will affect you, but it won't affect you at all because part of your money too is working at some point for you. So now let's work on matching goals to instruments, matching your financial goals to the best investment instrument. So there are different frameworks or goals and then the best financial instrument associated with that. So let's dive into that. The first one is the emergency fund. If your goal is to create a strong emergency fund, then the best investment instrument or avenue for you are the savings account and then the money market fund. And this is because whenever that you need access to it, you can get it. And we all know that it is very safe and liquid as well. So if you are in for the emergency fund, then the best investment instrument for it is the savings account and then the money market fund. Now, if you are in for house deposit, that means you keep on depositing for the next 3 to 5 years, then the best investment instrument for you is the fixed deposit, T-bills, conservative bonds. And you might be wondering why. This is because it has a predictable growth and then capital preservation and known timeline. You know that you'll be gaining your returns plus your capital in the next 100 days, or let's say 194 days or anything. So it has a known timeline. You know that in 3 months time I'm going to receive my investment returns and anything like that. Okay, so if your goal is to retire, that is retirement for the next 20, 40 years, then the best investment avenue for you is the stock index fund, the mutual fund, and real estate. And this is because of its, timeline. It has a long timeline. Okay, and even if there's inflation, because of how long the investment is, it will outpace the inflation. So we also have the children's education. So if all right, so if Hamdia decided that okay, in the next 15 years, definitely I'm going to get married and have my own kids. So let me start planning for my kids. So I'll be investing for my children's education so that in the next 10, 18 years, I won't have to be thinking about their school fees. So for that one, the best investment instrument for you is the education savings plan plus stock or bonds. So you just have to balance your fund. And this is because it has a moderate timeline. It needs growth, but also it needs less volatility. And that is why you shouldn't go in directly for stocks, but you should try to balance the investment avenues. Okay. And for some of us, we love money. We want our money to be working for us so that we'll be earning passive income. So the best investment instrument for us is dividend paying stock or capital gaining stocks, okay, rental property and bonds as well. So now let's look at some of the investment avenues in Ghana. So we have the savings or the fixed deposits. Most investment banks normally do this, or even most banks normally do this. We also have the government bonds, the government T bills, the treasury bills. We also have the mutual fund, and of course, we have the stock market being regulated by the Ghana Stock Exchange. We have the real estate, and finally, we have private business, trying to build your own business. Okay, so, as a young person or as a young investor, these are some common mistakes that you should avoid doing it. The first one is investing based on hot tips from friends who heard something. So, we all do this. We go on social media, we see self-acclaimed expert or stock expert telling you that go and buy this particular stock because it's good, the returns are good, you make money and all that. So, you also rush to go and buy it. For the past few weeks, we've been hearing about Casapreco, we've been hearing about Zen Company. People rush to go and buy those. I'm not saying they are bad, but as a reasonable investor, you need to do your proper research analysis before you go in for any of this. Or you can just reach out to a professional broker, talk to him about your financial needs or goals, and based on that, they recommend the best investment instrument for you. And you shouldn't be following trends on social media without really understanding it, whether crypto, whether stocks or anything. And you should also not put all your money in one investment, okay? And please don't try to be investing your emergency fund. It's not really good. Don't try, because when you need your emergency and it's in an investment instrument, it will be hard to access it, and that will be a problem for you. Okay, so I will end by telling you this: when it comes to investment, simplicity will always beat complexity. Don't try to make your investment plans difficult or so complex that it's difficult for you to even understand. No, go in for simplicity. And also understand that boring financial or investment instruments will always beat exciting ones. So know that when it comes to investment, it's about patience and timing. Okay, then consistency will always beat cleverness. That one we should all know by now, because for the past 2 months we've been talking about the power of consistency and all that. Okay, so that'll be the end for tonight's session, and I will hand it over to Sebastian. I'm not really sure there's any question, so we can dive into the exercises for this week. And I don't even see the need for that, since we don't have much members for tonight. So maybe we can call it an end. But Sebastian, please, are you here?
Yeah, yeah. Oh, you can. I don't know if Dia has any question. If so, she can ask and then you clarify that. Otherwise, you can quickly walk through the exercises and then, yeah. Yeah, hello, Ambi, are you here? Do you have any questions, any concerns, anything?
No, please, I'm okay.
All right, that's fine. Thank you. I mean, then we can quickly walk through the exercises and then we end it for today.
All right, so these are the exercises for this week. The first one is matching your investment type. Okay, So this exercise will help you to understand which investment type suits your different goals. Okay. So this is an example. The goal, maybe emergency fund, the timeline 0 to 3 month access, the best investment type, you list it, and then your why. Maybe need immediate access or safety matters most. Okay. So we have different goals. You have to an associated timeline. So you have to sit down and then choose the best investment type for you. Okay. So we have the available investment types. So we have the savings, we have the fixed deposit, the T-bills, mutual funds, individual stock, real estate, and business ownership. So you will have to select after that. And after that, we have some questions for you to answer. What patterns do you notice between timeline and investment type? Why will using stock for a 2 year goal be dangerous? Why will using a savings account for 30-year retirement be unwise and all that? Okay. So let's look at exercise 6. Personal goal to instrument mapping. Okay, so this exercise maps your specific goal to appropriate investment. So you just have to list your actual financial goal, the timeline, and then the appropriate investment instrument for each. As simple as that. And once you are done, there are some questions for you to answer, the reflection questions. We have which goal is your highest priority, which goal should use the safest investment approach, and all that. Okay, so these are the exercises for the week, and please do all to work on that and share it by Sunday. Okay, so on Sunday too, you are expected to share your reflection on this week, what you've done so far. Share it on the page. Okay, so you are expected to share one goal and its match instrument. So this is an example. I want to retire in 28 years with 1,200,000 cedis. Based on my timeline and risk tolerance, stock index are most appropriate. I am starting with 500 cedis monthly and will increase as my income grows. As simple as that. Okay, so I believe that for now we all understand different investment types and how to match them to goals. We have a conceptual map of the investing landscape. So next week will be focused on the integration week. As we all know, we are going to integrate all that we've done for this month, and then we focus on a lot of exercises. Okay, so you will synthesize everything from this month into a long-term wealth direction statement. You will commit to patient discipline, long-term thinking. Okay, so next week is the final week of our cohort, and we should all look forward to the clarity. Thank you so much.